This show is part of OnePlace, a daily network of focused briefings across the stories people follow most.
Welcome to our daily roundup. We are diving into the biggest shifts in tech, energy, and the global economy to keep you informed on the trends shaping our world today. Let's begin.
Tech workers are ditching corporate life for AI startups.
Texas power demand could quadruple from data center growth.
Bank of England warns of a looming stock correction.
Oil prices hit triple digits amid naval standoff tensions.
Trump considers a federal bailout for struggling Spirit Airlines.
Major layoffs continue across Amazon, Meta, and Target stores.
The U.S. government might buy Spirit to turn profit.
Microsoft and Meta cut staff while doubling AI spending.
First, the startup boom.
We are seeing a massive shift where former big tech employees are trading their stable six-figure salaries for the unpredictable world of AI startups. This isn't just a few people. Business applications in the U.S. reached nearly 6 million recently, the highest since 2004. Many of these entrepreneurs, like Nicole Landis-Ferragonio and Joe Lukes, were pushed over the edge by strict return-to-office mandates. When Amazon required a 5-day in-office week, it sparked a realization about the lack of personal agency in corporate roles. At the same time, the rapid rise of generative AI has created a narrow window of opportunity that many feel they must seize now or miss out forever. It is a unique combination of corporate push and technological pull driving this new wave.
It is fascinating because the risk profile of starting a business has changed. In the past, leaving a giant like Google or Meta felt like a massive gamble. But with constant layoffs happening across the industry, staying put doesn't feel as safe as it once did. Taylor Lassagne, a former manager at Google, mentioned that the uncertainty of job security made it much easier to take a buyout and focus on her own coaching business. When the safe option no longer feels secure, the upside of entrepreneurship becomes much more attractive. We are seeing people like Jason White leave roles at Meta to build AI tools for household finance. They are betting that their skills are better utilized in their own ventures than waiting for the next round of corporate restructuring or another mandate.
Next, the power crisis.
The physical infrastructure required for AI is putting an incredible strain on the electrical grid, especially in Texas. The grid operator there, ERCOT, recently warned that power demand could quadruple by 2032. This surge is almost entirely driven by massive data center projects. Texas is actually on track to surpass Virginia as the data center capital of the world by 2030. It is not just a southern issue, though. The Mid-Continent Independent System Operator, which covers 15 states in the Midwest and South, expects a 35% increase in demand by 2035. States like Michigan, Indiana, and Illinois are seeing a concentration of these projects from giants like Amazon, Google, and Microsoft. The scale of energy needed to process AI workloads is simply unprecedented in the history of regional grid management.
This demand is so high that some developers are actually giving up on the public grid entirely. Companies like Oracle and OpenAI are looking at building their own on-site power plants, often using natural gas to bypass the years-long wait times for grid connections. ERCOT is currently struggling with the fact that their existing transmission lines and power plants simply cannot keep up with the forecast. There is even some skepticism from the grid operator about whether these forecasts will fully materialize, as they are seeking to consult with regulators on adjusting these massive projections. However, the trend is clear. The digital gold rush requires a physical amount of electricity that our current systems were never designed to handle. Finding the funding and the fuel for these centers is becoming the next big bottleneck.
Now to the markets.
A top official at the Bank of England is sounding the alarm on global stock markets. Deputy Governor Sarah Breeden warned that asset prices are currently at all-time highs despite a mountain of global risks. She specifically pointed out that while the U.S. market has been hitting record levels, the underlying reality includes conflicts in the Middle East and economic shocks that could trigger a rapid readjustment. The fear is that several risks could crystallize at once, such as a sudden drop in AI valuations, combined with a loss of confidence in private credit. While she isn't predicting an immediate crash today or tomorrow, she is urging the UK financial system to build up enough resilience to survive a sharp downward adjustment. It is a sobering reminder that market optimism often ignores the fragility of the global economy.
We are also seeing UK companies prepare for a much tougher inflationary environment. New data shows that firms expect to hike their prices by over 4% by 2027, which is a significant jump from previous estimates. This shift is largely driven by rising energy costs linked to international conflicts. Chief financial officers are reporting that their expectations for inflation are climbing, which suggests that the cost of living pressures aren't going away anytime soon. Investment directors are noting that while markets have been somewhat wobbly, they haven't yet fully priced in the potential for a sustained downturn. Breeden's comments actually pushed the markets down slightly as investors began to weigh her warnings against their own growth projections. The disconnect between high share prices and the actual risks on the ground is becoming harder for central bankers to ignore.
Moving to oil prices.
Oil prices have surged past the $105 mark as tensions in the Strait of Hormuz reach a breaking point. Both the United States and Iran have been seizing ships, effectively closing off one of the world's most vital energy transit points. Brent crude and West Texas Intermediate have both seen steady gains as the naval standoff shows no signs of a quick resolution. While there was a brief moment of optimism following a ceasefire agreement between Israel and Lebanon, the broader conflict between the U.S. and Iran has evolved into a series of dueling naval blockades. Iran is demanding that all vessels receive permission to cross the strait, while the U.S. continues to intercept Iranian tankers. This economic leverage game is driving up costs for everyone and creating massive uncertainty in the global energy markets.
Market analysts are warning that the longer this waterway remains closed, the higher the economic toll will be. Some experts believe the U.S. might be forced to concede first due to mounting political pressure at home, though the risk of a major military escalation remains very high. Investors have been looking for any excuse to stay optimistic, but the reality of a blockade is hard to ignore. As one strategist put it, a ceasefire is a strange term to use when you have active blockades and rolling animosities. The International Energy Agency is also watching closely, as the world's energy security is directly tied to the stability of this region. For now, the market is bracing for a non-linear de-escalation, meaning things could get much worse before they get any better for global oil consumers.
Next, the Spirit bailout.
The future of Spirit Airlines is now a major political talking point, after Donald Trump suggested the federal government should step in. Spirit has been struggling for 2 years, facing bankruptcy and a failed merger with JetBlue that was blocked on antitrust grounds. Trump mentioned to CNBC that the government might need to help them out, but this idea is meeting significant resistance. Analysts like Jamie Baker from JP Morgan are hoping this remains a low-probability scenario. The concern is that if the government bails out Spirit, other airlines like JetBlue, Frontier, or even American Airlines might line up for their own cash infusions. Baker suggests that instead of a full bailout, the administration should focus on an orderly wind-down of the company to protect passengers while reallocating the airline's fleet and assets to more stable carriers.
Politicians are also weighing in with heavy skepticism. Senator Elizabeth Warren questioned what the American people would actually get out of a taxpayer-funded bailout, especially if failed executives aren't held accountable. She even linked Spirit's downfall to high fuel prices caused by international tensions. On the other side of the industry, United Airlines CEO Scott Kirby stated that well-run airlines are still profitable even in this tough environment, implying that a bailout shouldn't be necessary for those who manage their business well. He noted that United isn't worried about Spirit's fate affecting their own operations. The debate highlights a fundamental tension between saving a budget carrier to maintain competition and the moral hazard of using public funds to rescue a company that has struggled to find a path to profitability on its own.
Now, the layoff list.
Despite the talk of growth in some sectors, layoffs are hitting hard across major corporations in 2026. Amazon has announced it is cutting roughly 16,000 corporate roles globally as part of an effort to reduce internal bureaucracy. This follows a previous round of 14,000 cuts just a few months prior. It is not just tech either. Target is shifting resources away from its supply chain and into physical stores as part of a turnaround strategy under its new CEO. Even companies like Pinterest and Angie are trimming their workforces, with Pinterest specifically citing AI as a factor in its decision to let go of nearly 15% of its staff. More than 100 companies have filed official notices of upcoming job cuts, signaling that the trend of workforce reduction that started a few years ago is far from over.
The role of artificial intelligence in these layoffs is becoming more explicit. A World Economic Forum survey found that 41% of companies worldwide expect to reduce their staff over the next 5 years because of AI integration. While jobs in big data and fintech are expected to grow, traditional roles are being phased out as automation takes over. Companies like Block and Tailwind have already cited AI as a primary reason for their recent staff reductions. This creates a strange paradox where companies are investing billions into new technology while simultaneously letting go of the people who helped them reach their current scale. As we move through 2026, we are seeing a fundamental restructuring of the labor market, where efficiency is being prioritized over headcount, leaving many workers to navigate a very uncertain professional landscape.
Back to Spirit's fate.
Donald Trump has clarified his stance on Spirit Airlines, suggesting that the U.S. government should actually buy the carrier outright. During an event at the Oval Office, he mentioned that the government is considering either a bailout or a direct purchase to stave off liquidation. His logic is that the U.S. could acquire the airline virtually debt-free, hold on to its assets like aircraft and routes, and then sell it for a profit once oil prices eventually drop. High fuel costs have been the second largest expense for Spirit, making it nearly impossible for them to exit their second Chapter 11 bankruptcy. Trump's proposal is essentially a government-led buy low, sell high strategy, treating the airline as a distressed asset that the taxpayers could flip for a gain once the global energy market stabilizes.
This potential move would be a massive intervention in the private aviation market. By negotiating directly with the White House, Spirit is looking for a lifeline that the private sector has so far refused to provide. If the government does move forward with a purchase, it would mean the public owns a major, ultra-low-cost carrier, which could have huge implications for ticket prices and competition. Trump seems confident that the airline's assets are valuable enough to justify the risk, but critics worry about the precedent of the government acting as a private equity firm. The terms of this potential deal are still being finalized, but the idea of the U.S. owning an airline to turn a profit is a radical departure from typical federal intervention. It remains to be seen if this plan can gain enough political support to move forward.
Finally, AI spending shifts.
Meta and Microsoft are both making massive cuts to their staff while simultaneously pouring record amounts of money into AI infrastructure. Meta recently informed employees that it would cut about 10% of its personnel, which is nearly 8,000 people, to boost efficiency. This is part of a broader plan to offset the staggering $115 to $135 billion they plan to spend on AI this year. Mark Zuckerberg has been very open about the fact that AI is making some hiring unnecessary, noting that projects that once required large teams can now be handled by a single talented person using advanced tools. It is a clear signal that the company is pivoting its entire business model around the capabilities of generative AI, even if it means a significantly smaller human workforce.
Microsoft is following a similar path, offering voluntary retirement to about 7% of its U.S. workforce. They are also projected to spend upwards of $120 billion on AI infrastructure in the coming fiscal year. Microsoft's AI chief, Mustafa Suleyman, has even stated that he believes AI will be able to replace most white-collar work within the next year or so. Satya Nadella has been championing the company's internal use of AI, claiming it already handles 30% of their coding work and has led to major productivity gains. This shift shows that the tech giants are no longer just talking about AI as a future prospect. They are actively replacing human labor with it today. The scale of the investment is breathtaking, but the human cost is becoming increasingly apparent as these companies lean into a more automated future.
That's our roundup for today. Thank you for joining us for this briefing on the stories that matter. Be sure to follow the show for your next daily update.